Everyone already knows why MoviePass died. $9.95 a month, all the movies you could watch, 1 ticket a day, at almost any theater in America. Of course, it collapsed. You can't sell $10 bills for $5 and stay in business. That's the version everyone repeats. And it's wrong. The $9.95 price wasn't a mistake. Losing money on every ticket was the plan, working as designed. MoviePass wasn't funded by its subscribers. It was funded by a struggling little public company's stock, and for one strange year, the more MoviePass lost, the more that stock was worth. This is what actually killed MoviePass, not the price. Not financial advice, just a look at what happened. On the record. MoviePass started in 2011, and for most of its life, it was a small, careful idea. Stacy Spikes, a former Miramax marketing executive, co-founded it on a simple pitch. A ticket subscription could get people into theaters more often, the way Netflix's DVD plan had changed rentals. But a theater ticket isn't a stream. Everyone has a hard cost, and the theater expects full price. So for 6 years, Spikes experimented tiered plans, city tests, usually $30 to $50 a month. It grew slowly. By the summer of 2017, MoviePass had only about 20,000 subscribers, a niche product, still hunting for a model that worked. That slow growth wasn't a lack of ambition. It was the math. When a subscriber walked into a theater, MoviePass usually paid full retail for the ticket $10, $12, $15, with no bulk discount in most of the country. A subscriber paying $40 a month who saw 3 movies had already erased the fee. Anyone who saw more cost the company money. The only way the numbers worked was to keep the price high enough that light users covered the heavy ones. Spikes kept it deliberately expensive for a reason. In 2017, new owners threw that reason out. In August 2017, a company called Helios and Matheson Analytics bought a majority stake in MoviePass. If you've never heard of Helios and Matheson, that's the point. It was a small, money-losing, publicly traded data analytics firm, led by a promoter named Ted Farnsworth, whose stock was close to being delisted from the NASDAQ for trading too low. Running MoviePass day-to-day was Mitch Lowe, an early Netflix executive and a former president of Redbox. On paper, a data company and a subscription veteran were teaming up to disrupt theaters. What actually happened had almost nothing to do with movies. On August 15, 2017, the new owners did the thing everyone remembers. They cut MoviePass to $9.95 a month, 1 movie in a theater, every day, if you wanted. For less than the price of a single ticket, you could see a movie a day for a month. The reaction was instant. Sign-up traffic crashed the servers. The roughly 20,000 subscribers became more than 500,000 by year's end, and passed 1 million faster than almost any consumer service before it. By June 2018, MoviePass claimed over 3 million, and every one of them lost the company money. Here's where the popular story goes wrong. Yes, MoviePass lost money on nearly every ticket. But the losing wasn't the accident, it was the engine. Helios and Matheson didn't need MoviePass to be profitable. It needed MoviePass to be enormous, fast, and constantly in the news. Because every new subscriber, every headline about explosive growth, supported the story it told Wall Street, that it was assembling the largest movie audience in America, and would one day turn all that data, what people watched, when, and where, into advertising and analytics worth far more than the tickets cost. Nobody had to believe that. They only had to believe it long enough to buy the stock. So how do you fund a company losing more than $20 million a month? You don't earn it, you print it. Because Helios and Matheson was publicly traded, it could issue new shares and sell them again and again for cash. As long as the subscriber count climbed and the data story stayed exciting, investors kept buying. So the loop ran. The stock funded the losses bought subscribers, the subscribers refreshed the story, and the story sold the next round of stock. To keep it going, the share count ballooned from a few million into the hundreds of millions and beyond. Each new share quietly worth a little less than the last. MoviePass wasn't paid for by people watching movies. It was paid for by people buying Helios and Matheson shares. For a while, the machine ran beautifully, but the burn was staggering. More than $20 million a month, sometimes far more. Paying theaters full price for tickets, subscribers used more, not less, the cheaper it got. And you could see how little this was about tickets in where the money went. In 2018, MoviePass started a division to invest in films its own subscribers would watch, and used it to help distribute Gotti, a John Travolta mob biopic that scored a famous 0% on Rotten Tomatoes. A company bleeding $20 million a month had become a movie financier. The tickets lost money. The story just had to keep growing. By the spring of 2018, reality was leaking through, and the company started throwing switches to slow the bleeding so erratically that subscribers never knew what they'd bought. It floated surge pricing on busy showtimes, capped the plan at a few movies a month, then changed the terms again. It blacked out big releases and made people photograph their paper ticket stubs. The one thing that made MoviePass magic walk up, any movie, any day, was being quietly dismantled to make it survivable. The impossible deal was starting to feel like a service fighting its own customers. Then the machine visibly seized. On July 26, 2018, MoviePass simply stopped working. Subscribers reached theaters and the app wouldn't load. The company couldn't pay the processor that fulfilled its tickets. To switch the service back on, Helios and Matheson borrowed $5 million in emergency cash overnight money at punishing terms, just to keep the lights on. A company claiming millions of subscribers and a revolutionary data business couldn't cover a single day of tickets without an emergency loan. The gap between the narrative and the bank balance had become impossible to ignore. And according to regulators, some of what came next wasn't cost-cutting at all. In a 2021 complaint, the Federal Trade Commission alleged that MoviePass, Mitch Lowe, and Ted Farnsworth deliberately tried to stop their most active subscribers from using the service they'd paid for. The FTC alleged the company invalidated heavy users' passwords under the guise of security, pushed them through a ticket verification process designed to trip them up, and quietly throttled access, all to cut the tickets it had to buy. I want to be careful. Those are the FTC's allegations, laid out in its filing. But the picture wasn't a company fixing a broken model, it was a company hiding that the model was never meant to work. Underneath everything, the real clock was the stock. To keep buying subscribers, Helios and Matheson had flooded the market with new shares, and flooding the market does exactly what you'd expect. The price collapsed, from tens of dollars toward a fraction of a single penny, until the company risked being kicked off the NASDAQ. In July 2018, the same month as the outage, it ran a 1-for-250 reverse stock split, turning every 250 shares into one, purely to force the price back above $1. It bought a brief bounce, then collapsed again. That was the real ending, hidden in a bookkeeping trick. The machine that turned stock into cash had run out of buyers. From there, it was gravity. With the stock destroyed and no more money to raise, nothing was left to fund the losses, and the losses were the only thing keeping the service alive. MoviePass raised prices, throttled what remained of the plan, and watched the subscribers it had spent a fortune acquiring leave as fast as they'd arrived. It cut off service, came back, limped along. On September 14, 2019, MoviePass shut down for good, telling subscribers it couldn't find the cash to continue. 3 million signups in under a year, gone in about the same amount of time. The parent didn't outlive it by long. In January 2020, Helios and Matheson Analytics filed for bankruptcy and shut down entirely. The stock that had funded the whole adventure, the stock that was, in the end, the actual product, was worthless. Investors who had bought the growth story, the data story, the disruption story, were left with nothing. The tickets had never been the point, but the losses were very real when they finally hit zero. Then came the reckoning, and here I have to be precise. In 2021, MoviePass and Helios and Matheson settled the Federal Trade Commission's case over the alleged sabotage of subscribers, without admitting wrongdoing. Separately, the Securities and Exchange Commission charged the company and its executives with misleading investors about how MoviePass made money and about its technology. And federal prosecutors brought criminal securities fraud charges against both Ted Farnsworth and Mitch Lowe, accusing them of deceiving the public to prop up the stock. In 2024, Ted Farnsworth pleaded guilty to securities fraud. These are matters of public record, regulator complaints, court filings, and a guilty plea. I'm not the one calling anyone a fraud. The government did that, in writing, and one man agreed. There's one last turn, and it's almost gentle. When the wreckage was auctioned in bankruptcy, the person who bought the MoviePass brand back was Stacy, the co-founder pushed aside when Helios and Matheson took over, the one who'd kept the price high precisely because he understood the math. In 2022, he relaunched MoviePass as a smaller, more careful company, built on credits and caps instead of unlimited everything. Whether the new version lasts is its own story, but there's a certain justice in it. The man who tried to build a real business got to try again, after the men who turned it into a stock were finished. So here's the correction. The popular story says MoviePass died because $9.95 for unlimited movies was obviously unsustainable. But $9.95 was never trying to be sustainable. Losing money on every ticket was the strategy, and for a while it worked perfectly, because the losses fed the growth fed the story, and the story sold the stock that paid for all of it. MoviePass didn't die when it started losing money. It was born losing money. It died the moment it ran out of stock to sell. When the share price collapsed and dilution stopped working, the funding vanished, and a service with 3 million subscribers was gone in months. The lesson isn't don't price tickets too cheap. It's that a company can look like it's in the business you think it's in, while quietly being in a completely different one. Every case file here is a collapse people remember for the wrong reason. If you want the next one, subscribe, and we'll take apart another.